Thanks for watching Lessons in Minutes with Jaylee. Like, share, and don't forget to subscribe.
Today, I'll be looking at preparing ledger accounts for movement of stock. In our previous lesson, we have looked at identifying stock, the accounts associated with the movement of stock, as well as the double entry concept as it relates to movement of stock. If you have missed those lessons, the links are in the description below. The question that I'll be using for this lesson is taken from the Frankwood Business Accounting text, and that is exercise 3.3. And you're asked to record the following transactions into the appropriate ledger accounts. What we're looking at is nothing different from double entry. No difference. Basically, what we're doing is debiting and crediting, but you need to look out for the application of the movement of stock. So we're going to begin with the first transaction, which states August 1st, 2016, started in business with $7,400 cash. Now, the two items affected are capital and cash. Where based on this transaction, we're seeing that our cash increases, and because there's an increase in cash, which is an asset, we're going to debit that account. Our capital also increases, and we are going to credit that account. And remember, we're carrying out the general principle of double entry, where for every debit, there is a corresponding credit. So we're going to record this transaction into the ledger accounts. The first account that I'll be opening is the capital account, and all we need to do is to write the title of the account at the top of the T. And this account should be credited based on the transaction. So on the credit side, our date is 2016, the month is August, and the day is August 1st. Our details is the other item affected, which is cash in this case, and the amount is 7,400. We have our credit entry, so we need our debit, and our debit entry should be recorded in our cash account. So I'm going to open an account for cash. So that is cash account, and our entry should be placed on the debit side. That is 2016, August 1st. Our details, the other item affected, which is capital, and the amount is 7,400. So we're finished with that first transaction. Let's move on to the second transaction, which is August 2nd, paid $7,000 of the opening cash into the bank account. The two items affected are cash and bank, where we're seeing a reduction in the cash because the money is coming from the cash account and you're putting that into the bank, so the bank is increasing. Both items are assets. When asset increase, we are to debit. So the account to be debited is bank, and the account to be credited is cash. Let's make our entry into the ledger accounts. We have our cash account already, so we're going to take the money out of the cash by crediting. So that is 2016, August 2nd. Our details is the other item affected. In this case, it is bank, and the amount is $7,000. We have our credit entry. So we need to make our debit entry. And in this case, it should be placed in our bank account. We don't have a bank account as yet. So we're going to open a new account. And that is going to be called bank account. And remember, to do that, all you simply need to do is to put the title at the top of the T. This is our bank account. And we need to make a debit entry. So all we need to do is to place our entry on the debit side, and that is August 2nd as our date. Our details is the other item affected, which is cash, and our amount is $7,000. Our next transaction reads August 4th, bought goods on credit, $410 from J. Watson. So we're seeing where goods are purchased. So the account affected is purchases on credit from J. Watson. So therefore, the other item affected is J. Watson because we're now owing J. Watson for those goods that we have not yet paid for. We use purchases because we have bought goods for sale. It said goods. So once your transaction said bought goods, purchased goods, then the account that should be used is purchases. This is an increase in goods, which is an asset. So therefore, our purchases account must be debited based on the double entry rule. And the other item, which is J. Watson, should be credited because that's an increase in the value of what we're owing to our creditor. So we're going to record those into the ledger, and we need to open account for purchases. So by writing the title at the top of the page, and that is purchases account. This account should be debited. So on the left-hand side, we're going to enter our date, which is August 4th. Our details is J. Watson because that's the other item affected. And the amount is $410. So remember, once you purchase goods, once you buy items for resale, then the account to be used is purchases because that is stock. And we debit the purchases account because that's an increase in the stock, which is an asset. Our next account that is affected is J. Watson, and we need to open an account for this individual. So we need this creditor account, and this account should be credited based on the transaction. So our date is August 4th. Remember, when you're crediting, all you're doing is putting the entry on the right-hand side. And the details is the other item affected, which is purchases, and the amount is $410. Our next transaction, because we both have our debit and credit entries, is bought a van by check, $4,920. No, this is saying that we purchased a van. Are we going to be using our purchases account? No, we're not going to use purchases account because the van was not purchased for resale. If it is that the business that is being operated is a motor vehicle business and they indicate that they bought the vehicle for resale, then you can use purchases account. In this case, that was not indicated. So basically, the van is purchased to be used in the business, so therefore it is a fixed asset. So the items affected are check, which is bank, and van. So based on the transaction, our van account increases because we are seeing that van is coming into the business, the value of van increases, and that is an asset. So therefore, we are going to debit our van account. And our bank account will be credited because the money was taken from the bank to pay for the van. And that's a reduction in assets. So therefore, we are going to credit. So let's make our entries in the ledgers. We have our bank account already, so we're going to simply make the credit entry in that. And that is August 5th. Our details is van because that's the other item affected. And the value for that is $4,920. We need to open an account for van by simply writing the title at the top of the T's, that is van account. And this account should be debited. So we're going to put this entry on the left-hand side of the T. So it is August 5th. Our details is the other item affected, which is bank. And the amount is $4,920. All we're doing is applying the double entry concept. Remember, if the account is to be debited, you're placing the entry on the left-hand side of the account. And the entry, remember, includes your date, your details, and your amount. And if you're to credit the account, the entry, just the same, which is your date, details, and amount, must be placed on the credit side of the account. Okay, let's move into the other transaction. That is August 7th, bought goods for cash. What are two items affected by this transaction? We have purchased goods, so therefore the account that is affected is purchases, and this was made using cash. So the next account affected is cash. Once we have the purchase of goods, that's an increase in the asset. So we're going to debit purchases account, and the other account should be credited, which is cash, because that's a reduction in our asset. We have our purchases account already. So all we're doing is to make our entries. That is August 7. Our details is cash, because that's the other item affected. And the amount is $362. Now we're going to move to our cash account and put our credit entry in that. So it is August 7. Our details is purchases, and the amount is $362. So remember, because you have purchased goods, we use the purchases account to record that. And if you should go back to the previous transaction where we have purchased the van, because it was not goods, we did not use the purchases account any at all, because the van was not purchased for resale. It was purchased to be used in the business, and therefore we opened an account for the van. So we have to open a fixed asset account once you are not purchasing the item for resale. Okay, let's move into the next transaction, and that is sold goods on credit, $218 to L less. And the two items affected are sales, because we have sold goods. We're selling items that were bought for resale. So therefore we use the application of the sales account, which is related to asset of stock. These goods were sold on credit. So the next item affected is our debtor, which is L less. The account to be debited will be L less, because the debtor is owing us more, which is an asset. And the sales account is credited because we sold goods, the value of goods going down, and therefore we apply the principle where when your asset decreases, you are to credit. So let's make those entries in the appropriate ledger account. We need to open an account for sales. So this is sales account. And the account should be credited. So we're going to place the entry on the right-hand side. And our date is August 10. Our details is L less. That's the other item affected. And the amount is $218. We need to open an account for L less, and that is by placing the title at the top of the T. And we need to make this entry on the debit side, because that's an increase in the value of what the debtor is owing, which is an asset. So we're debiting, so it is August 10. Our details is sales, and the amount is $218. So remember, we debited the account, and in debiting the account, you're putting the date, the details, and the amount on the left-hand side. Let's move on to the other transaction, and that is August 12, returned goods to J. Watson, $42. So we're seeing that the business is returning $42 worth of goods back to the supplier. In this case, the two items affected are return outwards and the person that we're returning the goods to, which is J. Watson. Returns outwards account should be credited because the goods are going out, which is a reduction in the assets. So we're going to credit, and J. Watson will be debited because it's showing that we're owing less to this supplier. So we have less that we're owing to the creditor. So therefore, we are to debit that account. So let's meet the entries in the respective accounts. We need to open an account for returns outwards. And we're to credit this account. So on the right-hand side, August 12th, for details is J. Watson. That's the person that we're returning the goods to. And the amount that is being returned is $42. So once you return goods to your suppliers, the returns outwards account should be credited while the supplier's account is debited. So we're going to go to J. Watson's account because we have that already. And on the debit side, we're going to put our entry, which is August 12. Our details is returns outwards. And the amount is $42. All right. And we're going to move into our next transaction. And that is August 19th. Sold goods for cash. And once you sell goods, it means that our sales account is affected and that should be credited, showing a reduction in the asset. And the other item affected is cash, and the cash account will be debited because we have received that amount of money in cash, and cash is an asset, so we are going to debit. So we're going to make our entries, and we need to put our entry in the sales account by crediting, and that is August 19. Our details is cash, which is the other item affected, and the amount for that transaction is $54. And we need to show that we have an increase in cash by going to our cash account and debiting the account. So it is August 19. Our details is sales, which is the other item affected, and the amount is $54. And we're going to move into our next transaction. It is August 20th. LS returned goods to us, $18. So we're seeing that our debtor is returning some goods, and the two items affected are returns inwards and L less. Returns inwards because goods are coming back into the business from the customer, and L less because this is the person that is returning goods to us. Returns inwards is showing an increase in goods, so therefore we're going to debit that account, and L less account should be credited to show that the debtor is owing us less. So let's make the record in the accounts. And that is August 20th. We need to get to LS account. And here it is, showing a reduction. It is August 20th. Our details is returns inwards. And the amount that is returned to us is $18 worth of goods. And we need to open an account for returns inwards. And we are going to debit this account by putting the entry on the left-hand side. So it is August 20th. Our details is the name of the customer that returned to us, which is LS, and the amount is $18. So remember, we use the sales, the purchases, the return inwards and return outwards account only if the transaction is associated with goods. And we're going to move into our final transaction. And this is bought fixtures on credit from Firelighters Limited. What are the items affected? Are we going to use a purchases account? No, because we did not purchase goods. We cannot use any of those accounts associated with goods, with movement of stock, if it is that we don't have a transaction relating to goods. So in this case, we did not buy goods, we purchased fixtures. The business is not buying and selling fixtures, and it did not indicate that the fixtures were purchased for resale. So hence we need to show the effect in the fixtures account, and we have to show that we're owing Firelighters. So therefore the other account affected is Firelighters. We bought the fixtures, so that's an increase in fixtures. So the fixtures account should be debited because that's an asset, and we're owing Firelighters more. So therefore Firelighters account should be credited because that's an increase in liability. So we need to open an account for fixtures by placing the account title at the top of the T. So that's fixtures account. And this is an increase in the fixtures, which is assets. So we're debiting August 22nd. Our details is Firelighters Limited. And the amount for that transaction is $820. And the account to be credited, which we don't have as yet, so we need to open an account for that, and that is Firelighters Limited account. And this should be credited. In crediting, we're placing the entry on the right-hand side. So it is August 22nd. Our details is fixtures. And the amount is $820. And that should be placed in the amount column. All right. So basically, what we have done is we have carried out the double entry concept as it relates to movement of stock, but you realize that there were some transactions that which you're used to, yes. So all we did was to add to your knowledge as it relates to double entry, where you have seen the introduction of return outwards accounts, and that is used if goods are returned by the business to the suppliers. You have also seen the introduction of the returns inwards account, and this account was used when the customer returned goods back to us. It has to be stock, it has to be goods, it has to be inventory, it cannot be any other item that is returned to the business that you're going to put in returns inwards account. So if it is that we had sold some fixtures, which was fixed asset purchase to be used in the business, but fixtures is now being returned back to the business, we cannot use return inwards account. We would have to put that in our fixtures account. Why? Because fixtures was not bought primarily for resale. So the only time you'll use the return inwards account, the returns outwards account, is if it's related to goods. Similarly, the only time you will use the sales account is if goods are sold. So if goods are sold, then of course you use the sales account and you would credit to show a reduction in the asset of stock. And the other item, which is purchases, and this account was used when we bought goods, which would be stock, which would be inventory, items bought primarily for resale. Then we place it in our purchases account. However, you notice that when we have purchased the van, this was not placed in the purchases account, it was placed in the van account, mainly because the van was not purchased for resale, it was purchased to be used in the business. So therefore, you have to show that there is an increase in that particular asset. Okay, so that basically takes us to the end of this lesson, where we looked at preparing ledger accounts for movement of stock.
Like, share, and don't forget to subscribe.